Hello, here's our next video. This one from Chapter 18. There are going to be two on Chapter 18. This is the first one on the accumulated earnings tax. The other one will be on the personal holding company tax. Now, both of these taxes have in common that they are designed to offset another strategy that taxpayers would use, specifically that stockholders would use, to avoid the double taxation of corporate income. And so let's look at the accumulated earnings tax imposed on unreasonable accumulations of earnings by corporations. Okay, so again, this is in response to taxpayers who are trying to avoid the double taxation of corporate income, in this case, by accumulating earnings in the corporation. So we say double taxation of corporate income. That happens, first of all, we're taxed at the corporate level when the income is earned. And then when we distribute the income, the earnings are taxed again as dividends. So some shareholders say, okay, fine. If you're going to tax me a second time when I distribute the earnings, I know what I'll do. I'll just won't distribute them. I'll leave them in the corporation. I'm getting by okay on my salary or whatever. I don't need the money to pay my rent and buy groceries. So I'll just leave the money in the corporation. Corporation doesn't particularly need it, but if you're going to tax me a second time, then fine, I'll leave it in the corporation. And Congress said, no, wait a minute. If you're going to avoid taxation by avoiding distributions, we are going to create a tax on accumulated earnings. Unreasonable accumulations is the term they use, and of course, that immediately raises the question, so what do you mean by unreasonable? Who's to say what is or what is not unreasonable? Well, this is what they came up with. It's assessed at the maximum individual tax rate on qualified dividends. So it's saying this is the amount you should have paid as a dividend. We're going to tax you. We're going to tax the corporation using the dividend rate, which nowadays is 20%. That's the maximum rate on qualified dividends. Okay. So the tax is going to apply to all corporations. Doesn't matter the size. Typically, we think about the accumulated earnings tax as being a tax that is assessed on closely held corporations, but there is no rule that says that it is restricted to closely held corporations. Any corporation of any size can be subject to the accumulated earnings tax. There is a story about Microsoft that went for years during the big expansion of its business and the explosion of the PCs back in the 80s and 90s, right before the internet changed things. Before there was an internet, there were personal computers that could be used to use the internet. Okay, so you couldn't have an internet until you had personal computers. Microsoft was very much involved in the development of personal computers. And they went years without paying any dividend because they said we can always do something more to expand our business as opposed to paying a dividend. And so they said, okay, we won't pay a dividend. We've got better things we can do than pay a dividend. But by 2003, they started to get pressure. Now, the pressure wasn't just from the IRS. It was also from stockholders, because stockholders of publicly traded companies tend to put pressure on the corporation to pay a dividend, which is why you don't see the accumulated earnings tax a lot for publicly traded companies. But in Microsoft's case, they were making a case to the shareholders that the stock is better off as a pure growth stock with no dividends. But eventually the IRS also chimed in and said, you guys are going to start owing us an accumulated earnings tax if you don't start paying a dividend. So in 2003, they finally relented and said, okay, we'll pay a dividend. And they've been paying dividends ever since. But they could have been subject to the accumulated earnings tax. None was ever assessed. The pressure from the stockholders and the pressure from the IRS was enough to convince the leaders, Bill Gates and company of Microsoft, that they should start paying a dividend. So here's the accumulated earnings tax. The tax base is called accumulated taxable income. And we're going to multiply that, as we said before, by the maximum dividend tax rate. So we already know that is 20%. The accumulated taxable income, we're going to compute that as, first of all, we're going to take taxable income and make some adjustments to it. So we'll just call that adjusted taxable income. That's actually my term. You won't find that in any official tax documents or anywhere in the Internal Revenue Code. But that's just what I call it. Our textbook has a different name for it, which we'll get to in a second. But anyway, so we'll take taxable income, make some adjustments, then we'll have a dividends paid deduction. Because, of course, the whole point is you're going to tax me for not paying a dividend. So if you did pay a dividend, we're going to let you subtract that out. That makes sense. And then there's finally something else called an accumulated earnings credit. Now, you've heard me criticize Congress before when they come up with a poor name for something. Well, here's an example of a poor name. Credit is supposed to be a subtraction from tax. This is a subtraction in arriving at the tax base of accumulated taxable income. So it's not a credit, it's a deduction. But they called it the accumulated earnings credit, so we're stuck with that name. That's a little too bad. It basically makes sense. The biggest problem that we're going to have with this is that, of course, accumulated earnings, the entire concept of accumulated earnings, is basically a balance sheet concept. It's retained earnings. That's what retained earnings is on the balance sheet. It's the accumulated, undistributed earnings of the corporation. That's a balance sheet concept. But this tax base is called accumulated taxable income. That's an income concept. So how are we going to make that pivot? Well, you'll see that it's going to happen inside the accumulated earnings credit. So when we get there, you'll see the pivot from balance sheet to income statement when we get there. All right. So first, adjusted taxable income. That's definitely an income concept. We're going to start with taxable income. But here's the point I was making before. Our textbook gives it a different name. There is no official name for this thing. Our textbook uses the term current earnings, which implies that they're talking about current earnings and profits. You will find that when we look at adjusted taxable income, it's very similar to the concept of current earnings and profits, which is another adjusted taxable income. We take taxable income, adjust it in one way. We get current earnings and profits. We adjust it in a slightly different way. We get the adjusted taxable income for the accumulated earnings credit, which our textbook refers to as current earnings. I think a little awkwardly. I don't like that term. That's not Congress's fault, though. That is the editors of the CCH textbook who came up with that term. So we won't blame Congress for that one. Okay, we have plenty of other terms that we can blame Congress for, but this one is strictly on our textbook. Okay, so here it is. Adjusted taxable income or current earnings or whatever you want to call it. Start with taxable income, and then here are our adjustments. First of all, we get to subtract out, as you would with earnings and profit, federal income taxes. It's a non-deductible expense, but hey, I can't distribute this, federal government. If you made me pay it to you in taxes, it's not available to distribute to the stockholders. Okay. Also, charitable contributions. You didn't let me deduct charitable contributions in excess of 10% of one measure of taxable income, but I still made the contribution, and so therefore you ought to let me subtract that out. So yes, you can. You can subtract out excess charitable contributions. Disallowed capital losses, basically the same thing. Okay, I can only deduct capital losses to the extent I have capital gains, but I still had the loss, and so you ought to let me subtract that. And they say, yes, you can. Okay. And they also said, we're going to let you subtract out capital gains as well. It says their net capital gain, net of tax. There's two nets in there, and that's correct. There are two nets. First of all, net capital gain means capital gains net of any capital losses. So if you had capital losses, they were disallowed and you subtracted them up above. If you had capital gains that were bigger than the capital losses, then you could deduct all the capital losses and only pay tax on the net capital gain. So that's the first net. It's just capital gain net of capital losses. But secondly, it's net of tax, because up above, hey, you let me deduct those, subtract, I shouldn't say deduct, the federal income taxes. I guess deduct is okay. Anyway, you let me subtract federal income taxes. Now, if you take out a portion of the tax base, which is the net capital gain, well, then you're going to have to do that net of tax. So whatever tax was associated with that capital gain, you got to take that out of the number that you are subtracting. Okay, but you do get to subtract the net capital gain. Okay, so our adjusted taxable income is only going to be ordinary income minus some non-deductible expenses, etc. We're going to have some add back as well, the dividends received deduction. We can subtract. If some of our income was dividends received from another corporation, we can subtract, as you know, 50 or 65 or perhaps 100% of the dividends received from the other corporation. Well, they're not going to give you that to determine how much you should have paid your stockholders in dividends. So you have to add that back. Also have to add back any NOL deduction carryover. You had an NOL from prior years. That changed this year's taxable income. Well, we don't care about that. We're talking about what of your earnings from this year should you have distributed. And so if you had an NOL that was in there calculating your taxable income, you got to add that back in. And same thing with capital losses, carried over or carried back. Now, of course, you're not going to know about any capital loss carrybacks until a future year happens. But what that says is if you have a capital loss carryback, that is not going to reduce your adjusted taxable income from the year you carry that capital loss back to. You're not going to be able to adjust your accumulated earnings tax if you carry the capital loss carryback to a prior year. You might get some income tax back, but you're not going to get any accumulated earnings tax back by doing that. Okay, so there is your adjusted taxable income. Next is the dividends paid deduction. Okay, now don't get confused. We just talked about the dividends received deduction as one of the add backs in adjusted taxable income. The dividends received deduction we've known about since Chapter 14. Is one of the deductions that corporations get in calculating taxable income. This is the dividends paid deduction, which applies to the accumulated earnings tax. So this is brand new. And this is where we say, okay, we're only going to tax you for undistributed earnings and profits. If you distributed them, then we don't need to tax you for that. You got the message. You paid a dividend. So what is the dividends paid deduction? That is equal to, first of all, dividends paid during the year. That makes sense. From January 1 to December 31, what did you pay to your stockholders? Pretty simple. They're also going to give you the first 2.5 months of the following year. So it's the old March 15th. A lot of times corporations have until March 15th of the next year to do a lot of things. One of them, they have until March 15th, which by the way is also the due date of a calendar year corporate tax return, to perhaps fix something. Say, oh, we should have paid more dividends. We didn't do it. Now we've got an accumulated earnings tax problem. Well, if it's only March 12th, you still have a couple of days before you have to calculate your accumulated earnings tax. So you've got some time, a little bit of time. Okay, 2.5 months. Now, no double dipping. Next year, if you have to come in and calculate your accumulated earnings tax next year, and you use this dividend as one of the deductions in calculating your accumulated taxable income from the prior year, you can't use it again. So you took you paid a dividend March 12th, 2020. When you calculated your 2019 accumulated earnings tax, you took that deduction. Now you're doing your 2020 return. You cannot take that same dividend and count it as a dividend paid during the year. It was paid during the year, but you already used it last year. You can't use it again. No double dipping. All right. Consent dividends. These are funny things. These are dividends that didn't actually happen. We're just going to pretend they happen. Pretend dividends, as I say. Okay. Consent dividends are pretend dividends. You get to pretend that you paid a dividend even though you didn't. The consent is the part where the stockholder says, okay, I consent to including that pretend dividend on my individual tax return as a dividend received, even though I never got the money. So we're going to pretend I got the money, and I'm going to pay tax as if I got the money. You have to get stockholders' consent because they could very much claim, without signing that consent, they could claim, hey, that wasn't income to me. I don't care what the corporation did. I never got that. So you've got to get the stockholder consent in order to do this. But if it is a closely held corporation, it's probably very difficult to do a consent dividend on, on Microsoft. They couldn't have gotten away with a consent dividend. The stockholders would have said, no, you got to give me a real dividend. But in a closely held corporation, you can do that. You go to the stockholders, which is just a handful of people, and you say, we need to do a consent dividend. Everybody, you're going to have to put a dividend on your tax return. And they say, well, that's going to cost me up to 20% on my tax return. And you answer yes, but it will cost exactly 20% on the corporate return if we don't do it. So we're probably better off paying that dividend and letting you pay the tax at the shareholder level, which might be less than 20%, rather than paying out the full 20% at the corporate level. Okay, so the shareholders have to consent. And then at the corporate level, you're going to record this. You're going to essentially debit retained earnings, dividend paid, and credit paid in capital. So you are going to treat it as a dividend distribution where the cash went out, but then immediately came back in the door as a contribution to capital from the shareholders, because no cash actually did change hands there. Okay, so that's how you would book it. So there's your dividends paid deduction. And then finally, the accumulated earnings credit. This is going to be our pivot to from the income concept that we've been dealing with to the balance sheet concept. So we're going to start with the amount of accumulated earnings necessary to meet the reasonable needs of the business. There's that word again, reasonable. So we're going to figure out how much do we have to have accumulated in order to run our business. We have to have assets to run the business. In order to have assets, we had to get them somewhere. We either had to have paid in capital that financed the acquisition of the assets, or borrowing, perhaps, to finance the acquisition of the assets, or retained earnings. And so the amount of retained earnings necessary to meet the reasonable needs of the business, that's going to be our starting point. It is reasonable to retain earnings in order to grow your business. There's that net capital gain deduction again. It's the same old thing. They let us take that out of the adjusted taxable income. And now here we're subtracting it again. So you might be thinking, wait a minute. You let me reduce my adjusted taxable income by the net capital gain deduction. That was right there. Net capital gain, net of tax. Okay, you let me take that out from adjusted taxable income. Now, you're going to make me also reduce my accumulated earnings credit by the same amount. It's going to be a wash. Why did you tease me by letting me reduce my adjusted taxable income if you're going to just make me also reduce my accumulated earnings credit by the same amount? Well, we'll see that a lot of times it is a wash, but sometimes it's not. So we'll see how in just a little bit. But first of all, to finish up our accumulated earnings credit, the final piece there, here's our pivot to get from balance sheet to income statement. The amount of accumulated earnings, that's how much earnings did we need to have accumulated to meet the reasonable needs of our business. That's definitely a balance sheet concept. The net capital gain deduction is clearly an income income statement concept. But then here it is. Subtract out beginning accumulated earnings and profits, and now it's how much did we need to accumulate this year to meet the reasonable needs of the business. And that is our accumulated earnings credit. And so it's that subtraction of beginning accumulated earnings and profits that gets us to pivot from income statement or from balance sheet to income statement, because the tax base is an income item, not a balance sheet item. Okay, so that's the accumulated earnings credit. Now, there is one other thing, and this will get to that net capital gain deduction thing. The amount necessary for the reasonable needs of the business, that term, minus the capital gain deduction, so everything except the subtracting out of the beginning accumulated E&P, there is a minimum of $250,000. So if you calculate the accumulated earnings necessary to meet the reasonable needs of the business and you find that that's $200,000 and you had a $10,000 net capital gain deduction, that would come out to $190,000. You are allowed to substitute $250,000. That's bigger, and so you would go with the bigger number. Remember, this is a credit. This is going to be a subtraction in the total tax base. You want this accumulated earnings credit to be as big as possible. And so you'll take the $250,000 rather than the $190,000. And so that means you don't actually wind up reducing your credit by the net capital gain deduction, because that doesn't figure into the minimum of $250,000. So if you are at a point where you're using the minimum $250,000, then back when you were calculating adjusted taxable income and you got to subtract out your net capital gain deduction, you still get that benefit. If you calculate this term, amount needed for the reasonable needs of the business minus the net capital gain deduction, and it turns out to be $500,000. Well, you're not going to substitute $250,000 for that. You're going to take the $500,000, which means subtracting the net capital gain deduction. You subtract it from adjusted taxable income. You subtract it again from the accumulated earnings credit, and the whole thing washes out. So you get really no benefit from that net capital gain deduction. But if you're using the minimum, then you do. Okay, now that minimum, $250,000, if you have a personal service corporation, then substitute $150,000, not $250,000. So corporations whose revenue is generated primarily from the personal services of individuals. So a tax preparation corporation would be an example of that. Personal service of preparing people's tax returns for them. Now your minimum is $150,000 instead of $250,000. I guess they figured that personal service corporations don't need as much in the way of assets as grocery stores and car washes and other things which would not count as personal service corporations. Okay. Problem number 21 from Chapter 18 is a tax service corporation. It is called the Loophole Tax Service, Inc. Isn't that the name you want on your tax return when you send it to the IRS? The Loophole Tax Service, Inc. Anyway, that's the name of the corporation. It has accumulated earnings of $135,000. Current earnings, adjusted taxable income in our parlance, of $60,000. The dividends paid deduction is $8,500, and the reasonable needs of the business are $160,000. Okay, so accumulated earnings as of the beginning of the year, that's the $135,000, and reasonable needs of the business, $160,000. What is the accumulated earnings credit? Okay, so they're only looking for the accumulated earnings credit. And so what is it? Well, it's the greater of the reasonable needs of the business, $160,000, or the minimum for a personal service corporation, which is $150,000. So clearly $160,000 is bigger. And then subtract from that beginning earnings and profit of $135,000. So that's going to be $160,000 minus $135,000, $25,000. So that is the answer to the problem. But they gave us all this other information. And so, and I noticed the solution manual Also, the person who did the solution manual said, I don't have to stop here. There's actually more we can do, even though we've answered the question. The solution manual went forward with the rest of it because you could actually take this thing all the way out to figuring out what the accumulated earnings tax is. And so they said, well, why not? Let's do it. And so I thought, you know what? Well, it's a good idea. Let's do it. So we've got the accumulated earnings tax. We've got accumulated taxable income, which is equal to adjusted taxable income minus the dividends paid deduction minus the accumulated earnings credit. Adjusted taxable income, that's the current earnings, as they call it, of $60,000. Dividends paid deduction, they said, was $8,500, and we just figured out that the accumulated earnings credit is $25,000. That gives us accumulated taxable income. That is the tax base for the accumulated earnings tax of $26,500. So the tax, $26,500 times the flat tax rate of 20% gives you $5,300. So that's our accumulated earnings tax in this situation. So there you go. That is the accumulated earnings tax. Let's continue on. Oh, yes, we still haven't talked about how do you figure out exactly what are the reasonable needs of the business. This is really where the rubber hits the road in terms of the accumulated earnings tax. The rest of it is pretty much just, finding the numbers and plugging them into the formulas. Here is where the judgment comes in. So what is a reasonable need of the business? Goes back to the old prudent business person rule. What would a prudent business person consider prudent for the present business needs and the reasonably anticipated future business needs of this corporation? Reasonably anticipated future needs, they're very specific that they must be specific plans. Not just, well, we'd like to expand over to the east side sometime, but we want to buy the property at, on East 10th Street between Mohawk and Utica, something like that. So specific and definite. We want to do that. We've got a price. The sellers have told us they will sell that property for $150,000, and it's feasible. We can do that, and we think it'll make sense for us to expand our business to that property over on the east side. If you are at that point, so it can't just be, well, we think this business would do better if it grows in the future. We'd like to save up for that future growth and then figure out how we're going to do it, but much more specific about how we're going to grow, where are we going to go to do it, what do we need to get that done. Okay. There are some things which have been specifically allowed either by the code itself or more frequently by the regulations. So some things that the Treasury Department has said these are going to be allowed as reasonable needs. Expansion, what we just said, as long as you've got specific, definite, and feasible plans for expanding your plant or simply replacing, say this machinery is worn out, we're going to have to buy new. Either of those things, if you've got specific, definite, and feasible plans to do that, you are allowed to save up for it by accumulating earnings. Acquisition of a business, if that is, again, a specific and feasible and definite plan to acquire some other business, you can save up for that. Retirement of debt, always allowed. You've got debt, you want to pay it off, accumulate earnings so you can pay off that debt. Provide working capital. We'll get to that in more detail, but basically you got to have enough cash on hand to pay your bills as they come due. You want to make loans to suppliers or customers. This would be a reasonable business need because you might very much want to keep a particular supplier afloat. They might need some capital that they can't get from their bank. They need to get it from their favorite customer, which is you. Or same thing with customers. They might need a little help along the way, and you don't want to lose them as a customer. Maybe you'll make a loan. And this is the one that's actually in the code. Congress said, we have to provide for potential product liability losses. Why they came up with that particular thing as the only one that, as members of Congress, they thought they should mention, I don't know. But there you go. Product liability losses. Congress says you can accumulate earnings in order to provide for product liability losses. The rest of them came from the Treasury. Okay. Specifically not allowed. Some things that they said, you know what? We don't care. You cannot use this as an excuse for accumulated earnings. First one, pretty obvious, loans to shareholders. You cannot walk into the IRS and say, I couldn't pay that dividend to my shareholders because I was saving up to make a loan to those very same shareholders. Pay them the dividend, then they won't need the loan. Okay, so that one makes a lot of sense. Loans unrelated to the business. They just want to make sure, you're not, I'm going to lend to something which really doesn't have anything to do with this corporation, but maybe there's some other reason why the bosses, meaning probably the shareholders, want me to make this loan. That's kind of like a loan to the shareholder, although maybe a little bit indirect. Provide for unrealistic hazards, like, a pandemic taking over the entire United States. That could never happen. So, or maybe something even more unrealistic. I don't know. Suddenly unrealistic hazards. My definition of unrealistic hazards has broadened considerably in the last couple of weeks. But anyway, there we are. If the Treasury Department, if the IRS thinks you are providing for an unrealistic hazard, then they will say that's a reason why we're not going to allow that as one of the items in your reasonable needs of your business. Okay, now providing for working capital. This one needs a little bit more description. And so let's go back and talk about that one. The working capital requirement. There was a court case. And it was Bardol versus the U.S. or Commissioner of Internal Revenue is probably the defendant. The IRS is always the defendant in tax cases because what it is you file your tax return. The IRS says we don't like it. We think you have to make adjustments. You go back to the IRS, say we think you're wrong. We don't want to make those adjustments. They say, well, we think you're going to have to make the adjustments anyway. And then it is the taxpayer says, all right, we're going to court. So the taxpayer sues the IRS to remove the assessment of the additional tax. So the taxpayer is the plaintiff. The government is the defendant in these cases. So this was Bardol versus the Commissioner of Internal Revenue. And Bardol won. And this has become known as the Bardol formula. And here's how it works. They say, first of all, calculate your inventory cycle. The inventory cycle is defined as average inventory divided by cost of goods sold. So if you think about what is your inventory during the year and what is your cost of goods sold during the year, what if that comes out to 1/6? Well, what that would say is that on average, an item in inventory is sitting on the shelf in your business for 1/6 of a year, 2 months. So it's a measure of the average time for an item to sell. An item you have in inventory, how long does it take for it to turn into a sale? Okay, that's the inventory cycle. And there's the receivable cycle, which is average accounts receivable divided by net credit sales. That's the net is just net of any returns and allowances you might have. Okay. Average accounts receivable. Well, again, if you think about your total sales during the year, what's your average level of accounts receivable? That would give you a measure of how long does it take to collect on an account receivable. And then you also have a payable cycle, which is average accounts payable. And we're assuming in this example that the accounts payable are only for inventory purchases. You could modify this for accounts payable, which also picks up things like utility bills and other expenses, as well as just inventory purchases. In the original Bardol example, though, it was just purchases as the numerator, and of course that is going to be your average payment time. Okay, so we've got these three cycles. We're going to define the operating cycle as the inventory cycle plus the receivable cycle minus the payable cycle. That's going to be our operating cycle. So here's a timeline. It's a nice little line. From the date of purchase to the date of sale is one period, and then from the date of sale to the date of collection, another period. The third or the fourth point in time that we want on this timeline is the date of payment that you made for your purchases. So I just stuck that in there. It doesn't have to be before or after date of sale. It could be either one. I put it in just a little before. Okay. So the date of purchase to the date of sale, on average, that's our inventory cycle. The amount of time that an item in inventory sits on the shelf from the day you purchase it till the day you sell it. From date of sale to date of collection is our receivable cycle. How long from the time you make the sale until the customer actually pays you, that's the receivable cycle. And then from date of purchase to date of payment, that's the payable cycle. So if you take the inventory cycle and add the receivable cycle, you get from purchase to collection. And then if you subtract out the payment cycle, the payable cycle, you get from payment to collection, and that's the operating cycle. So how much, what is the period of time that your money is tied up from the point that you made payment for your inventory until you actually got to collect on the sale of that inventory item? That's your operating cycle, and you've got to have enough cash on hand to cover all of your outgoing payments for that period of time. So your working capital requirement is equal to the operating cycle, as we have just defined it, multiplied by all the cash you're going to need to lay out. Now, the operating cycle is, as we've talked about it, it's a period of time, and you can measure it a lot of different ways. I prefer to think of it as a fraction of a year. If it is a fraction of a year, and that's how I've been talking about it to this point, then just take your cost of goods sold, your other expenses. Remember, in tax, we don't consider cost of goods sold an expense. Financial, we do. Anyway, don't worry about that. Cost of goods sold and your other expenses, but not depreciation, because, of course, that does not require the outlay of cash. So you got to subtract that out. Same thing would be true for amortization as well. And also, in case you weren't counting as expenses your federal income tax, well, that also has to be counted as something you're going to need cash for. And so it's not a deductible expense. Again, in financial accounting terms, it would certainly be considered an expense. So that's what you need to have cash on hand to do during that operating cycle. So if those are all annual amounts and the operating cycle is a fraction of a year, well, then that is essentially how much working capital you're going to have on hand so that you can cover all of those payments while you're waiting to get paid by your customer. Okay. A lot of people define these cycles in terms, they're still measures of time, but a lot of people want to call them days. And so they'll take the same formulas we had and then multiply by 365. So the inventory cycle is so many days, receivable cycle so many days. If you do that, you're going to multiply all those things by 365 so you get them expressed as days, well, then your expenses are going to have to be per day. Your outlays are going to have to be per day. So you take all these annual amounts and divide by 365. It seems silly to me to multiply one part of this thing by 365 and divide another thing by the same 365. Why bother? Just use it as fractions of a year. It's much easier. But you will see a lot of people express that in terms of days and expenses and outlays per day. And so don't freak out if you see that. If it's on the CPA exam and they're doing it all in days, well, go by how the person who wrote the exam question is going. Otherwise, you'll get very confused. Okay, so it's just the length of time times the outlays over that length of time. That's the working capital requirement. All right, let's see how that works in problem number 24. Margot's Cookies, Inc. First of all, not a personal service corporation. And they have working capital of $210,000. They have operating figures. We have their average inventory, average receivables, average payables, purchases, sales, cost of goods sold, and other expenses other than cost of goods sold, which includes depreciation and taxes. Okay. According to the Bardolph formula, what is Margot's working capital need in total? Okay. The inventory cycle is 150 over 600,000. That is your average inventory of 150,000 divided by cost of goods sold of 600,000. Now notice in all these cycles, it's a balance sheet term in the numerator and an income statement term in the denominator. That's why those numerator items, balance sheet, those are average over the year. Easiest way to do that is beginning plus ending divided by 2. If you want to be a little bit more refined, you could do it monthly. What was your end of the month inventory for 12 months divided by 12? Or daily, it depends. Weighted average amount of inventory, you could do that using pretty much any reasonable formula that you wanted. But most commonly what people do is beginning plus ending over 2. Anyway, so here we have 150 over 600, which is 25% of a year, 3 months. Actually works out to 91 and a quarter days if you're going to do it by days. The receivable cycle. Accounts receivable 80,000 and net sales 960,000. So it's actually 1/12, 0.0833. So about a month. Again, in days, that comes out to 30.42. So a little longer than a 30-day month, a little shorter than a 31-day month. And then the payable cycle, that is average accounts payable is 50,000 and purchases 300,000. So again, we're assuming the payables are for inventory only, and that is 50 over 300, 1/6, about 2 months, 60.83 days. Okay, so you could also do this if you don't like decimals, if you prefer fractions, that's a quarter plus a 12th minus a 6th, which is 3/12 plus 2/12. Try it again. 3/12 plus 1/12 minus 2/12, which comes out to 2/12 or 1/6. Operating cycle is 1/6, 0.1667. All right. So the working capital requirement is 1/6 of cost of goods sold is 600,000, other expenses 440,000, but the other expenses includes 50,000 of depreciation, 90,000 of taxes. We're going to leave the taxes in there, but take out the depreciation because that does not require an outlay of cash. The taxes clearly does. Try telling the IRS you're going to pay your taxes, just not with cash. No, sorry. So that's 1/6 of 990,000, which is 165,000. That is the answer to the question. What is Margot Cookie's working capital need in total? 165,000. Unfortunately, they told us 210,000. So how much can we add to earnings to meet our need for working capital? Nothing, not this year. Nope, sorry. You've already got all the working capital you need and then some. And maybe you should distribute that excess as a dividend. But that is how you work the Bardolph formula. Okay. Problem 38. This is a comprehensive problem which covers all of the accumulated earnings tax. Scandinavian Furniture, Inc. is a calendar year corporation worried about the accumulated earnings tax. It's February, and we have the following facts available for the preceding years. We've got accumulated earnings and profits as of 12/31. Now, that means 12/31 of the year before that. In other words, they should have said January 1. So it's February of 2020. They're worried about the accumulated earnings for 2019. And the accumulated earnings and profits as of December 31st, 2018 was 220,000. So that's beginning E&P. Okay. We've got taxable income, not counting capital gains, of 110,000. There's some charitable contributions in excess of the amount limited of 10%, $3,000 over the limit that they couldn't deduct. That long-term capital gain is $10,000. They say taxable at 34%. They need to update their question. Long-term capital gains and all other income taxed at the corporate level is not taxed at 34%. There was a time it was. Not anymore. It's 21%. I'm going to go with 21%. So I'm not going to take their 34%, even though it's in there. Dividends from Canadian corporation. Okay, well, that's $7,000 of dividends that do not qualify for a dividends received deduction. Dividends from U.S. corporations that are 25% owned, they will qualify for the dividends received deduction. The dividends there are $8,000. And the total income tax liability, I'm going to ignore that number because that is also based on very old tax law. And so we're going to skip that. Demonstrable business needs through the Bardol formula and whatever other specific, definite, and feasible plans we may have totals $235,000. Okay. So let's see what we have here. Taxable income before capital gains was 100,000. We had that long-term capital gain of 10. So that's taxable income of 120,000. Now, what we need to do is make adjustments to get to adjusted taxable income. Federal taxes, I guess I did take that number of 60,000, even though we know that 21% of 120,000, well, that's 50% of 120,000. So I don't know, that would be about 24,000. I can't do that in my head. Anyway, it would be less. I got 25.2, I think is the right number. Anyway, it's not 60,000. But I took their number, so we can subtract it. The excess charitable contributions, we can subtract them. We did pay those contributions. Maybe we paid the 60,000 because we just had a lot of estimated taxes, and we'll get that back next year when we apply for our refund. All right, that works. Anyway, for the capital gain, that one I did say, no, 21%. And so the net capital gain is 7,900. We can subtract that out. And the dividends received deduction. Remember, there were two dividends, the Canadian and the U.S. We can't get any dividend received deduction on the Canadian dividends of 7,000, but on the U.S. dividends of 8,000, we can. And that's 65% of 8,000. That is 5,200. We have to add that back. So that is an addition there. We took the dividends received deduction, and that figured into the calculation of the $100,000 of taxable income before capital gains. Now we have to add that back. So we took it out, and now we have to put it back in. Okay. So our adjusted taxable income comes out to $54,300. Okay, take that number. And now our dividends paid deduction, well, that's none. They said we're going to take the consent dividend route. So we don't have any dividends paid yet, but it's February, so we still have time that we can pay them after the end of the year. And so all we need to know is what is our accumulated earnings credit. The reasonable needs of the business, $235,000. The net capital gain that we would have to subtract out is $7,900. That gives us $227,100. But this is a furniture selling company, so not a personal service corp. So our minimum is $250. We're going to go with the $250, and then the credit is going to be that $250 minus beginning earnings and profit of $220,000 for an accumulated earnings credit of $30,000. And so our accumulated taxable income at this point, $24,300. And we're going to have to pay 20% of that, $4,860. as that one I can do in my head, as a accumulated earnings tax, or what they said is we're going to go the consent dividend route. What amount must be reported as a consent dividend to avoid the accumulated earnings tax, avoid the 4860 tax with a consent dividend of 24.3. Okay. And that, I believe, is it. Yes, it is. Okay. Thank you very much. That is the accumulated earnings tax. The other part of Chapter 18 is the personal holding company tax. Also designed as a penalty for excessive retention of earnings and failure to pay dividends. We'll talk about that in our next Chapter 18 video, and that will finish Chapter 18. So we'll have the personal holding company tax come up next. Thank you very much. See you then. Bye.